but we have added massively to our balance sheet. You all know that it exceeds $4 trillion US dollars. Previous to the crisis, we were slightly under 900 billion. And the way this has manifested itself is that we've seen a huge buildup in the reserves of the depository institutions of the United States. Only 30% of the financial assets in our country are in the hands of depository institutions. And they have accumulated on our balance sheet and in their own reserves and their own balance sheets, or deposited in terms of excess reserves, for which we pay 25 basis points per annum at the 12 Federal Reserve banks, including mine, a total of $2.75 trillion. That's up from 64 billion as the norm before the crisis. So that's been a huge multiple of accumulation. And therefore, we have a monetary base which is stout and rich and full and deep. And the issue really is now the next phase of transforming from that to anchoring the base interest rate. I mentioned the buildup in reserves because clearly we've yet to see it activated or see velocity pick up such that it transfers itself into the job creation that we as uniquely in a central banking world having a dual mandate are responsible for assisting. Not only must we maintain price stability and move towards the 2% target that was mentioned by Governor Kuroda, but we also have the responsibility to conduct monetary policy in a way that engenders full employment over the intermediate term. So this really is the issue for us presently. It appears to me that the reaction to the statement we issued 2 days ago and the summary provided by our chairperson, Janet Yellen, of course, was less anxious than that which we engendered a year ago in the spring when we first voiced this transition and the possibility of existing. But nonetheless, I understand why it would be considered disagreeable, even if it is sound, by some market operators. And on this, I pulled no punches. It's my firm belief that we have made the life of money market operators quite easy because we have taken volatility out of the marketplace. When you move in one direction, it's pretty easy then for people to assume that that direction will be continued forever. And again, we're at a different stage. I noticed the last question that was asked by Lord Turner. We are at a different stage than the previous speaker in terms of our management. But basically where we are right now, when I talk about efficacy, is that we have, with quantitative easing, whether it is the total amount we have done or the amount that we did before we embarked on the third leg of that quantitative easing, is we have enriched the balance sheets of the private sector. Kuroda-san mentioned that the private sector was doing quite well in Japan, and I don't know if you gave the number in your speech, but if my memory is correct, roughly grew about 3% last year. We estimate at the Federal Reserve Bank of Dallas that our private sector grew at about 4% last year, but held back by fiscal drag and by also a weaker external account, so that our numbers were substandard in terms of total GDP growth. In essence, what we have done is we have enabled corporations to become muscular financially, to rebalance their balance sheet, and to be prepared to create jobs. But they haven't done so yet. And the question is, what is the incentive that we're providing? We've driven down nominal rates to historic records. For a short while, we had the lowest interest rates in 237 years of American history. They've come up somewhat, but nonetheless they're still quite attractive. And we are seeing, in my opinion, some exhibitions of excessive risk, and I've spoken of these publicly. First of all, if you look at stock market capitalization relative to overall GDP, if you look at the bull-bear spread, if you look at margin accounts being now again at a historic high, but most importantly, if you look at the credit markets, which is what I find to be the most important tool for us to assess the efficacy of what we do. And we see extraordinarily low interest rates on a nominal basis I mentioned, but other activity which raises at least one eyebrow, if not leads one to conclude that we might be stirring the waters a little bit too richly. And I'll point specifically in this instance to the spread between junk, CCC credits, historically low or near historic lows, but most importantly on top of extremely low investment grade yields. So basically what we have done is by driving down yields to that extent, investment grade corporate yields have been lower than the S&P 500's forward earnings. And that provides an arbitrage incentive for corporations to issue bonds and then use the proceeds not to expand CapEx, particularly job-creating CapEx, but instead to buy back shares and to engineer their bottom lines on an earnings per share basis such that their stocks keep appreciating, including dividend payouts. And this is not the original intention, although it's an understandable byproduct and a benefit of quantitative easing.